As we know, swing trading is a strategy that is a lot like catching the proverbial knife. Traders are not looking to necessarily identify a trend and follow it. Instead, they're looking for trend reversals, and that can be a dangerous game. What I'd like to point out to people is that it's possible to use options as a way to hedge more aggressive, what would be normally be more aggressive futures positions. In the written part of the article, we gave an example of a yen trade, somebody that was bullish the yen following this massive dip here that we saw in February and going into March. And hypothetically, somebody could have purchased a futures contract on the 24th of February here. At the time, probably looked like a pretty good deal. Looking back, we know that it wasn't necessarily perfect timing, but with the use of options, it might have been possible to alleviate some of the risk, in fact, limit the risk, and give the trader pretty good odds of coming out with their, with their skin, even if they're dead wrong. What this trader may have done is purchased a futures contract at 126.30. At the same time, purchased a put for 130 ticks. Now, 130 ticks, that's a lot of money. And, just like any other type of insurance that we purchase throughout our lives, if you don't need it, it seems like throwing good money after bad, and being that expensive, it's not a very fun venture. So one thing that this trader could have done is reduced the cost of the insurance by selling a 126 call. At the time, this option would have collected about 72 ticks. What that does is it reduces the cost of the insurance from 130 ticks to less than 60. In fact, 58 ticks is what it comes out to. 58 ticks is still a lot of money, but it's not the end of the world. I guarantee you, if you buy the yen, you buy a put, you sell a call, and it turns out you're dead wrong, you're not going to worry about the 58 ticks. You're going to be thankful that you had the insurance. The purpose of this chart is to give you a visual idea of where your profit zone is, where your loss zone is, and everything in between. The break even of the trade is going to be 124.18, and we get that by adding 58, the cost of our insurance, buying the put and then selling the call, plus where we entered the futures market, which is at 123.60. Anything above 124.18, the trade starts to make money. In fact, it makes money all the way up until 126, and this is where it maxes out. And it maxes out because we sold a 126 call. Above 126, we give up our profits. We're not out anything, but we're just not gaining anything. And that's not so bad, because at 126, the maximum profit on a trade like this would be $2,275. If you recall, our maximum risk is about $850, and we figured that by the premium that we paid for our insurance, 58, plus 10 ticks. And why 10 ticks? Because we bought a 123.50 put, and we're long the futures from 123.60. So that 10 ticks between 123.60 and 123.50 has to be accounted for. And you'll notice the maximum risk lies here below the strike price of our put, which was, again, 123.5. A perhaps simpler way to go about it would have been to purchase a futures contract. But somebody that would have purchased a futures contract and placed a stop at the suggested area in the article would have been risking a substantial amount of money. In fact, although the market up to the current date anyway has not ever reached that particular price, it has reached a low of just under 122. Actually, just right at 122. And at that particular time, the futures loss would have been somewhere around $1,800, well beyond what our total risk is on the trade using the option hedge. And again, another variation of this would have been to buy the future, buy the put, and not sell the call. If you think the yen is going to the moon and you don't want anything in your way, you don't necessarily have to sell the call. But here's what it does. Without selling the call, your break even moves all the way up here. That's that much further that the market has to travel for you to actually make money. And what does that do? It decreases the odds of success, it increases the cost of your insurance, and it probably gives you a little more stress.